So in this series, we've been looking at the 6 different ways that you can use other people's money to fund your business growth. And number 6 on the list is direct to finance. And whilst direct to finance isn't technically using other people's money, I wanted to include this because it is probably the most common method that small business owners actually utilise when it comes to funding their business growth. So when we're referring to direct to finance, what we're referring to is you as the business owner is putting your money into the business to fund its growth. Now, in the early stages of your business, this is generally referred to as bootstrapping, and it's pretty much how every business gets going. But when you're looking at a growth plan and maybe you need a much larger, typically a 6-figure cash injection, it's not uncommon for directors to potentially remortgage their house, for example. I know this is something that I've done. I remortgaged my house and I put over £500,000 into my business to fund it. So this also is referred to as a director's loan. So normally when people are thinking about a director's loan, they're thinking about the business lending them money, but it works the other way around too, in that you as the director can loan the business money. And regardless of whether you're loaning your business money for growth purposes or for any reason, I always recommend that you get an accountant to run a calculation on interest for you. So you are allowed to charge your business interest because essentially it's a commercial loan. Regardless of whether the business loans you money or loans a bank money, there is a commercial relationship there in terms of that loan. So you're entitled to charge interest on the loan. And you can charge that at the going commercial rate. So if, for example, you could go online quite easily and get 3 quotes that validate the interest rate that you're going to charge to your business. So I recommend that you get an accountant to run the calculations for you, because if you're going to charge your business interest, then it means that you personally on your tax return are going to have a potential tax liability for any interest that you receive. So you could have some cost to offset against that if you've got finance yourself to then go on and loan your business the money. But that really is why your accountant needs to crunch the numbers, because it depends what other income you've got and what tax bracket you're sitting in. But if you do charge your business interest on the director's loan, then any interest that you charge to your business is tax deductible. So that means that you save corporation tax at the applicable rate. So it's anywhere from 19 to 25% at the moment, corporation tax. So you would save that in corporation tax on your business. It would be tax deductible. So one of the things that you do need to consider when you're lending your business money is the hierarchy of creditors. And what this is a legal framework that is followed should the company go into liquidation. And what it means is that there is a set order that people that are owed money by your business will be paid out. So for example, typically at the top sits employees, for example. So if you owe your employees wages and you're in liquidation, then if there's any money left in the business after all of the costs have been paid for the liquidation process, then it would be paid out to your employees first. It would be paid out against any loans that were secured against specific assets. And so there's a various structure depending on the types of creditors, like suppliers, banks, and whether they're secured, unsecured, etc. But you as a director sit basically at the very, very bottom of that. So if you do lend your business money, you do need to be aware of that you would be the very last person to be paid should your business go under. And chances are if your business has gone under, then you're not going to see a penny of that back. So you do need to be prepared to lose that money should your business get into financial difficulty. One of the biggest benefits of direct to finance is that personal finance rates tend to be much cheaper than business finance rates. And this is where I use the example of where I remortgaged my house. So I needed £500,000 to fund my business. At the moment, if you need £500,000 on a personal mortgage, then you're looking at around 5% interest. But if you go and get a business loan, you'd be looking at probably 10 to 12% interest at the moment. So the rates can be staggeringly different. And that is one of the main benefits of using personal finance and then loaning the money into your business rather than going and securing a business loan.